I wanted to make a video reviewing re-entries for traders because a lot of things that people struggle with are re-entering trades. And in general, if you just wanted to boil it down to one rule or one statement, if you watch the rest of this video and you don't understand anything that I'm saying except for this one thing, this is what I want you to remember. It would be that whenever, so let's say you're in a trade, let's say you bought above 14. This is a practice day. I just traded. I'll go over what I did in a few minutes, but that was sort of my inspiration for this video is based on re-entries. So if you bought above 14, you can always exit when the other side needs a second leg. And you should familiarize yourself a lot with what needs a second leg and what doesn't. You know, three legs in general is going to need a second leg. So one, two, three, the Bears get a reversal. They'll probably need a second leg down. Big bars like 25 in general need second legs, stuff like that. So you can always, if you buy for the above 14, you can always exit when the other side needs a second leg. So maybe below 21, 20 and 21 is probably big enough for a second leg. You can certainly get out below 22 after, three straight bear bars. It's probably going to need a second leg down. You can always re-enter, even if that side doesn't get their second leg. You can always re-enter when you get another bar that needs a second leg. So if you're a bull, you can exit when the bears need a second leg, and you can get back in when the bulls need a second leg. This really only works if you're trading with the trend. So trading reversals is a lot less effective when you're trying to trade always in because the reversals usually fail. Look, the reversal ends up failing. The reversal ends up failing. And in real time, it can be really scary to sit through reversals, but I think it really just boils down to if the one side needs a second leg, get out. If we're still always in long and your side needs a second leg, get back in. That's the main concept of 90% of always in trading. And learning to re-enter is a difficult thing to do. Eventually you have to just learn how to pull the trigger. I think a lot of traders are really scared to pull the trigger because they're scared to lose. And I think that not being scared to lose is, one of the best things that you can really have because it makes you less scared to pull the trigger and you're going to learn faster. If you're scared to lose, stop trading real money or trade a much smaller position size. You can always trade a sim account. And, if you want to do whatever you want to do with your real account, go ahead and do that. But I think that at the least you should trade a sim account on the side and try to do all of this stuff. I personally was really stubborn for a long time I suppose I still am, about not wanting to stop, trading in a way that I thought was going to be profitable for me that day or whatever, and start just trading like an always in style. And so I think that something you can do that can be helpful is just trade one share on real money, one SPY share or whatever, a sim account, however much you want to trade, and just hold always in and hold through all the pullbacks. And what you'll eventually start to learn, you'll start to learn when the pullbacks are coming and how the pullbacks are going to look. And so basically, on this day, what I did was I bought above 14, as I mentioned, and I exited below 21. And then I bought more. I bought again above 25 because this now needs a second leg up, and the market's overall more bullish. The reason I say the market is overall more bullish is that we have three pushes down, one, two, and then three, and the third is an overshoot. And in general, when you get a breakout attempt below a bear channel, you want the breakout attempt to be a major breakout attempt. Breakout attempts or breakouts below bear channels and bull breakouts above bear channels, especially broad channels, right? Channels are a really important concept. I'm going to keep getting sidetracked further and further, but it's all important, really. But when you get a bear channel and it's broad, there's only really a 25% chance that you're going to get a strong breakout below. And so if it's going to be a 25%, one of those 25%, it's probably not going to be a weak looking breakout. It's probably going to be an exceptionally strong looking breakout. And we really didn't have that. And then we got a reversal up 14. And 14 is a bull bar that needs a second leg up. And so in this context, should the Bears be allowing the bull bar that needs a second leg up if they're going to get the low probability breakout? No. So this is probably part of the higher probability of time where the second leg up, or we end up testing back towards the top of the bull channel like we did here. On a day like this is another really important concept as well. So on a day like this, where we're staying below the moving average, I think a lot of traders would be tempted to buy above something like bar 17. And you can do that, but you're buying for a scalp. So if you buy above 17 and you get stopped out, and that's the type of trade that you take a lot, you should start doing the opposite of that. And I don't mean sell above 17, or sorry, I meant 17, not 18, but I don't mean sell above 17. I mean, what is the bar? So you have to ask yourself, if you're taking these types of trades, what's the bar where you think, oh gosh, I'm going to get stopped out? What's the bar that, turns on fear in your mind? Your emotions, you need to learn how to weaponize your emotions uh, and trade them essentially. Everyone feels fear or greed in the beginning, but it turns into uncertainty and confusion. And if you're buying above here, you're starting to feel uncertain, and now you're starting to feel certain in here that you're going to get stopped out. You could say that it's certainty or fear, whatever you want to call it, but wherever it is that you think you're going to get stopped out, that's where you should look to sell. So don't buy above 17. Instead, wait. And if you start to get the reversal back down, wherever it is that you would start to think, oh gosh, I'm about to get stopped out. That's where you can go short and, look to hold. And that's essentially, trading always in and always in flips and stuff like that. But I think that I'm just going to collect my thoughts here and just think about how I want to phrase this. I think that learning to get back in spots like this is crucial, and learning that, hey, we failed at the moving average 3 times so far today, we're probably going a lot lower. That's a really good thing to keep in mind. If you get, if the day opens and you get consistent failures at the moving average in either direction, you're probably going to go in the other direction. So consistent, a bull failure, and then another bull failure at the moving average, we're probably going lower. If we're, above the moving average and we get 3 basically bear failures at the moving average, we're probably going higher. There's an example of a day like that. I'm going to pull it up right now. And really, in a way, it comes back to calibrated expectations. Those are the most important things in the stock market. So this is that day, right, that I was just talking about. Bears tried to get to the moving average, failed. Bears tried to get to the moving average, failed. Bears again tried to get to the moving average and failed. And so if you're somebody who sold, let's say you sold below 20, what's your calibrated expectation for that trade? Well, your calibrated expectation is probably that you collapse below 20 and get a good bear bar on 21. And you don't end up getting that. So what about by the time you get to bar 22, what are you thinking? You're thinking, oh, this trade is not going very well. I might get stopped out. Well, but you're not sure yet, right? You're kind of in the middle about it. That's probably because 22 is a 50-50 trade, really, that you get a second leg down for the bears, or that we start to go higher. By the time you get to 24, wherever your stop is, if you're a bear, even if it's a wide stop, you think we're probably going a lot higher, and you probably want to get out of your trade. And that means that that's probably a good spot to buy. So learning how to use your emotions to enter those trades is really important. And I'm saying use your emotions. It really should be via your price action reading and your ability to do that stuff. But everyone feels emotions in the beginning when you're trading, and so I'm just trying to basically do my best to teach you about what your emotions are going to end up teaching you. And I really do believe that you should only enter on stop orders if you're starting out trading. I know they always say that, and I'm guilty of doing trading limit orders too. But the kind of cold reality to learning to trade with Albrook's methods is eventually you're going to learn that you need to mainly use stop orders 80 to 85% of the time in order to become profitable. And you can learn that now, or you can keep trading on limit orders for another year or 2 or 3 and then eventually learn it. So it's really just dependent on how fast you want to learn the lesson. It took me years to just accept that I'm going to make more money trading on stops than limit orders until I get to the point where I'm a very, very successful stop order trader. And it's much easier and more predictable to trade on stops because of your calibrated expectations are really important. And so in a spot like this, you can let's say you were long for any reason, you bought above 13, you can exit below 20 since it might need a second leg, and then you can buy again, whatever, 24, and hold until the bears need a second leg. Nothing too clear in here, but if you do exit for any reason, you can buy again above 46. We probably need another leg up, or 48. We probably need another leg up. And doing stuff like this, you're not going to make money all the time. You have to understand. Sometimes you're going to lose money on your entry, and then you're going to re-enter, and you're going to lose money on that too. Sometimes you're going to keep re-entering and basically just end up breaking even. And that's part of trading is you're going to take trades where you make money, and you're going to take trades where you lose money. And it doesn't mean that the trades where you make money is a good trade and the trade where you lost money is a bad trade. You have to just accept that you're going to lose trades and you're going to miss moves as well. You're going to get trapped out of moves. It's all part of trading. And if you sit there and have a bunch of regret, that's what's going to keep you from being successful. Regret is really unprofessional in this business. You can't have regret. You have to accept the fact that you're going to miss moves. If you get upset about missing moves, you're just basically denying yourself the ability to learn. And you can again, the simplest way to get back in is to just think, you get trapped out of your trade. And then when you get a bull bar that, let's say you're buying, you get trapped out of your trade and you get a bull bar that needs a second leg, you can just buy the close of that bar. Another way to think about it is you get trapped out of your trade and then it starts to go. Pretend you were still in the trade. Okay. So let's say I bought the close of 22 on this day, right? Let's say I bought this close of 22 and I'm disappointed in 23. And so I exit on the close of 23. And then I see 24. And if, a lot of people think, oh my God, I'm missing out. Now it's going to go without me. Well, if I had bought above 22 and let's say I didn't exit, would 24 make me happy? Would 24 make me think, oh my gosh, this is going to go a lot higher. I'm going to make money. If I had stayed in the trade, would I be thinking, oh, this is going to work. This is going to go really well. Now I think this is a high probability trade. If that's my thought process, then I can buy that close of 24 and expect us to go a lot higher. Because it's the same thing as if I had held above 22 and the close is 24, or if I buy the close of 24, it's the same thing. The market doesn't care about your entry price. And so when you get trapped out of a trade and it starts to go without you and you think, oh, there's probably a lot left to this move, I'm just going to miss it. Well, you can always just re-enter the trade at the market. And the other reality to this is you're not going to do it well on, tomorrow, on Friday. You're not going to do it well on Monday. It's going to take a lot of time and a lot of working at it to get really good at exiting and re-entering. And I think one of the problems people run into with trying to do always in trading is they try it for a week and they're not good at it and then they move on to something else. And that's really what's holding, people back from being profitable, is trying too many things. If you just really focus on always in, you're probably not going to be good at it for the first 6 months. You're probably not going to be good at it for the first year. But if you just specifically try to exit when one side needs a second leg and re-enter when your side needs a second leg, or some version of that, right? Exit below 20, it needs a second leg, re-enter above 24, since this clearly needs a second leg now. If you just consistently work on that and doing that in the always in direction, you're going to learn when the always in flips. You're going to learn how to exit, how to enter. You're going to learn all of that stuff, but it's going to take time. And so, excuse me. And so the more time that you spend just losing and working on this particular, always in, the better you're going to get at it. Again, you're going to buy the top of the trading range 1,000 times. You're going to sell the bottom of the trading range 1,000 times. You're going to exit at times when you shouldn't be exiting. You're going to do all of that so many times, but you have to. That's how you learn. And so if you do decide on Monday or Friday or whatever, okay, I'm going to do this second leg trading, whatever it is that, I'm mentioning right now, trading for second legs. And you should avoid third and fourth legs, by the way. But that's just something if you're trading the first leg for a second leg and the second leg for a third leg, that's good. If you're buying third legs and fourth legs, that's a problem. But just think about that a lot and it'll eventually click. But you're going to buy the third and fourth leg a whole bunch of times. That's just kind of part of trading. And you just have to continue to work at that specific method of trading and not give up on it. Because when people are trying to learn too many things, that's when they get, that's when they run into issues, versus just really focusing on one method of trading and let everything else come through that. But all right, that's really going to be it for this video. Like I said, I know it's probably a bit confusing and I probably don't convey my thoughts in the best way possible, but just focus on what I said at the beginning of the video, if nothing else. That's it.